So, introduction, module 1. One of the most important functions of business management is decision making. The success or failure of a business depends mainly on the quality of decision it takes. But decision making is not an easy job. A business manager comes across a large number of business problems like what to produce, how much to produce, what should be the input combination, how to promote sales, how to manage profit and capital, so on. Decision making is the only solution to solve all these problems. All these problems may have alternative solutions. Decision making is the process of selecting the best alternative solution to a business problem from among the various alternative solutions. A business manager cannot select particular alternative without studying the cost of benefit associated with each alternative solution. A detailed cost benefit analysis requires knowledge of economic concepts and principles. Economic theories provide concepts and principles which can be used by business managers to find solution to business problem. Economic theories also provide the knowledge of modern method of production and production at low cost. It also helps business managers to use their scarce resources in such a way as to maximize profit. Economics. The term economics owes its origin to the Greek word oikonomia, which means household. Economics is a science that deals with human wants and their satisfaction. Human beings have unlimited wants, and these wants are satisfied with the help of goods and services. In the day to day life, we have been using many products like food items, clothes, watches, pens, pencils, books, TV sets, cameras, cars, computers, and the list goes on. We also require the service of doctors, nurses, lawyers, teachers, launders, and so on. Thus, every one of us are consumers because we consume goods and services in our day to day life. In order to consume goods and services, we require money. But the money, that is resources, available for consumption is limited. Thus, human wants are unlimited, and the resources available for satisfying human wants are limited. Goods and services have to be produced for the people to consume. All those who are involved in the production of goods and services are called producers. Thus, farmer who produces rice and vegetables, a carpenter who makes tables and chairs, a pharmaceutical company who produces medicines, a transporter who distributes all these goods, a doctor, lawyer, teacher, etc., who produces services are all producers. Production requires resources and skill. In economics, by resources we mean factors of production such as land, labor, capital, and organization. These resources are scarce. It means that the availability of land, labor, capital, and skill are all limited. All the resources are capable of being used for different types of production. For example, a piece of land can be used for agriculture or for the construction of a factory or school or hospital. If the land is used for agriculture, then the other options have to be foregone. Thus, in economics, we say that resources have alternative uses. The government of a country has to utilize its scarce resources for various programs, wants of the people, for the benefit of the people. Economics is a subject which studies about problems arising out of unlimited wants and scarcity of resources which satisfy these wants. It studies not only about the problems of individual but also about the problems of society. Definition of economics. Professor Lionel Robbins of the London School of Economics defines economics as a science which studies human behavior as a relationship between ends, and scarce means, which have alternative uses. The definition is based on the following three fundamental propositions. Ends refers to human wants. Human beings have unlimited wants. If one want is satisfied, another want comes in. B. The means, that is, resources, to satisfy human wants are scarce. The term scarcity is used in relation to requirements. A commodity which is in existence in small quantities is not regarded as scarce if nobody has any use of it. On the other hand, a commodity may be in existence in large quantities. That is example, rice and wheat. But if the demand is more than its supply, it is regarded as scarce in economics. Thus, the term scarcity is used in a relative sense and not in absolute sense. C. Scarce means are capable of alternative uses. Economic problems would not have occurred if one resources could be put only to one use. Suppose a person has rupees 1 lakh. He may deposit the money in a bank and earn interest. He may buy a rickshaw and run as taxi. He may start a tea shop or retailer shop, and the alternatives go on. If he uses the money for one alternative, he has to sacrifice the other alternatives. In short, according to Robbins, unlimited wants and scarcity of resources from the fundamental of economics. In the words of G.J. Stigler, economics is the study of principles governing the allocation of scarce means among competing ends when the objective of allocation is to maximize the attainment of ends. Macroeconomics. The term macroeconomics is derived from the Greek word macros, meaning large. Thus, macroeconomics is the study of economics as a whole, rather than individual markets, consumers, and producers. Macroeconomics is defined as that branch of economics which deals with the aggregate economic variables of an economy, such as aggregate supply, aggregate demand, general price level, national income, etc. It is because of this reason that Professor Kenneth E. Boulding says macroeconomics deals A. Not with individual quantities but with aggregates of these quantities. B. Not with individual incomes but with national income. C. Not with individual prices but with general price level. D. Not with individual output but with the national output. Macroeconomics thus deals not with one family but all the families taken together, not with one firm but all the firms in an economy, not with one industry but the outline industrial structure of an economy. From the above discussion, it is clear that macroeconomics is a study of aggregates, and hence it is often described as aggregate economics. Importance of macroeconomics. The following are the importance of macroeconomics. A. To formulate and execute economic policies. Government of a country actively intervene in economic affairs. Accurate and reliable statistics of aggregate variables are essential for the formulation and execution of economic policies. For example, macroeconomics helps to measure the general price level in an economy and enable the government to implement policies to control inflation. B. To understand the working of an economy. The main economic problems are related to the behavior of total income, output, employment, and general price level. These aggregate variables are statistically measurable with the help of macroeconomics. It also helps to analyze the effect of these variables on the working of the economy of a country. See, to evaluate overall performance of an economy, the study of macroeconomics is very important for evaluating the overall performance of an economy in terms of increase or decrease in economic growth. It also helps to identify the factors responsible for decline in economic growth rate and to find reasonable solution. D. To develop microeconomics. In order to formulate microeconomic laws, a pre-study of aggregates affecting it is necessary. For example, the law of diminishing marginal utility could not have been developed if the experiences of masses of individuals had not been collected and taken into account. E. To help in business decision making. Application of macroeconomic concept and theories help business managers to get a clear understanding of the economic environment of a country. Future business plans such as conceiving new business venture, expansion of existing business, etc., depends on current and future economics environment. Thus, macroeconomics helps to a greater extent in business decision making.